Hello and welcome to this session in which we will discuss sourcing of income. The sourcing rules that are outlined in the IRS Revenue Code, they are essential in what? In determining how different type of income and deduction are categorized as either originating within the US or from international sources. What does that mean? Simply put, as a corporation, if we're talking about a corporation, they have to determine whether the income is a US income or a foreign. Now, why is that important? They either have to put it in this bucket or in this bucket. Well, if it's a US income, it goes into the US bucket. If it's a foreign income, it goes into the foreign bucket. Now, what is that going to generate? Well, this is going to generate a deduction. So, if the income in the US, we have to figure out if there's any relevant deduction for that income. Same thing with the foreign. We have to determine if we have any foreign deduction. Then if it's a foreign, we might get we have to pay taxes, and based on the taxes, we get a foreign tax credit. So that's why it's important for US entities, whether they are individual or corporation, to help them identify the portion of their income that qualify for foreign taxable income, which will impact their tax liabilities and tax credit for taxes paid to other countries. Once you determine if this income is foreign, then it's taxed based on the foreign rules, the deduction based on the foreign deductions, or US. These rules are also important for non-US persons, such as foreign individual or entities, because they define what income is subject to US taxation. What we will do in this session is go over 9 different categories of sourcing of income. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So the IRS outlined 9 categories of income that are considered to be sourced from within the US. Well, we're going to go over these 9 categories as usual, one by one. First one is interest. Well, this include interest earned from entities or obligations based in the US. So, if the payer is a US payer, it's a US income. For example, if a non-resident alien invests in a bond issued by a US corporation and receive interest payment, those payments are sourced from the US and will be subject to US taxation. When we say interest, again, think of who is the payer. If it's a US bank, US government entity, then it's a US income. So it's based on the payer. The payer determines whether the interest is US or non-US. If the payer is a US resident, then it's a US income. Dividend. Well, the source of dividend is typically based on the location of the corporation issuing the dividend. So the identity of the payer. Who's the payer? The location of the payer. So if a British investor owns shares in a US-based corporation and receive dividend, those dividends are considered US source dividend. Now, obviously, if you're a US and receive those dividends, definitely it's a US. Now, there's an exception here for dividend. If more than 25% of a foreign corporation income, so let's assume we have a Canadian company or some foreign company, is directly related to its business activities in the US over the 3 preceding year, when the dividend is paid, then the same proportion of the dividend is considered US source. So if you get paid money from a non-US company, so a non-US company, a Canadian company, paid you dividend. Well, this is a non-US company. However, if this Canadian company, remember, this is a Canadian company, it generates more than 25% of its income from business activities in the US, more than 25%, let's assume 40%. Well, guess what? Then when this Canadian company pays dividend, 40% of that income is what? Is US dividend. This means if a foreign company has significant business operation in the US that contributed to its earning, the dividend is paid can partially be treated as coming from the US, impacting how they are taxed. Simply put, for dividend, we look at who's the payer, unless there is this 25% rule. Let's take a look at an example that illustrates this point. Let's assume a foreign corporation, Global Tech, has been doing business in the US for the past 3 years. Over this period, 30% of their total income was generated from US operation, making it effectively connected with the US trade or business. In the current year, they decided to distribute dividend to the shareholders. Given that 30% of its income in the past 3 years was US connected, under the rule, 30% of the dividend paid to shareholder will be treated as US sourced income. Although it's a foreign company, it has enough connection to the US, more than 25% of its income generated, therefore 30%, then 30% of the income is based income. So if a Global Tech pays $100,000 in dividend, 30,000 of this amount would be considering coming from the US. And this portion might be subject to US taxation for the shareholder, well, depending also on their tax status and other applicable tax treaties. Personal service income. What does that mean? This category covers income earned from labor or services performed in the US. If you work in the US, this is a this is a US tax. There is an exception. So if you work in the US, it's a US income. It's as simple as that. You provide services in the US. There's a notable exception for non-resident alien who are in the US temporarily, transitory, and meet specific criteria. You have to be in the US less than 90 days, which is less than a quarter. Within that quarter, earn less than $3,000 for services performed, and working either for a non-US entity or for a US entity but performing services for a foreign office of that entity. What does that mean? It means, let's assume it's a Canadian company. They send you here to work in their branch in the US, but it's a Canadian company. We'll need the third category. So you're here less than a quarter, earn less than $3,000, and let's look at an example. A freelancer, which is a graphic designer from Canada, who comes to the US to work on a project for a US company, but only stays for 60 days, earn $2,500, would not have this income subject to the US, provided that this work is for a US company's Canadian office. So they send them from the Canadian office to work for the US, but it's for the Canadian office. Otherwise, if you work in the US, it's US income. Rents and royalties. Well, these categories include payment received for the use of real, remember, rental or intellectual property located in the US. For example, if a foreign individual owns a building in New York and receive rental income from the tenants, this income is a source to the US. Then any deduction related to that building in the US will be deducted against that income. Also, royalties paid for patent, copyrights, or other intellectual property. Royalties means you pay a fee to be able to use that software. Used in the US fall in this category as well. So, royalties paid for the use of patent used in the US fall under this category. For example, if a Japanese company licenses a software patent to a US company and receive royalty payment, these payments are considered US sourced income based on the location. Where is it being used? Where is it being used based on the location? Disposition of US real property interest. If you own property in the US and you get rid of it, income from selling or otherwise disposing of real estate located in the US, also US source income. This means that if a non-US citizen sells a property they own in the US, the gain is subject to US sourced income. For example, if a Canadian investor owns a vacation home in Florida and they sold it, the profit from that sale would be subject to US tax law because the location is Florida. Sale or exchange of inventory property. Profit made from selling inventory in the US that was purchased outside of the US. It doesn't matter if it's sold in the US, subject to US property. For example, a German manufacturer could produce a car in Germany, then sells them in the US. The income from the sale is considered US sourced income based on the location of the sale. Underwriting income. This category covers income earned from underwriting insurance or annuity contract, including reinsurance. For example, if a British insurance company underwrites life insurance policies for US residents, Well, if they underwrite it, they're going to be receiving premium. That's what? That's US sourced income. Social Security benefit. Well, Social Security benefit paid to non-resident alien is also considered US sourced income. Now, some treaties will exclude this, that's a different story, but nevertheless, it's a US sourced income. For example, if we have a retired British individual living in the UK, but they're receiving US Social Security benefit because they work here in the US when they were, during their working years. Well, that's considered US sourced income. Guarantees. Income from guarantees involving payment received. So if you receive the payment for what? For guaranteeing debt obligation, well, that's considered US sourced income. What's guaranteeing? A few guarantees. Fees for guaranteeing debt for US individual or a corporation. So someone paid you a fee to guarantee the debt for US, either a corporation or individual, that's US sourced income. Also, fees for guaranteeing the debt of a foreign entity are US sourced income if that debt is connected to the entity's US business activity, somehow related to the activity in the US, then that's a US income. For example, a fee for guaranteeing a loan that finances a foreign corporation, US operation, where the operation earned US connected income, would be considered US sourced income. So simply put, guarantees of any sorts of a debt that's connected to the individual in the US, a corporation, or a foreign corporation where that debt is connected to the business activities in the US is considered what? US sourced income. So once again, the sourcing income, after figuring out whether the income comes from the US or from abroad, then you will need to determine to distribute the permitted deduction, which we'll talk about the deduction in a separate recording, across either the US or the foreign earnings. And this step is crucial because that's going to determine your taxable income. That's going to determine your foreign tax credit. So the income from foreign sources is important because it's used to figure out the limit on foreign tax credit, which we'll talk about later. And this credit is designed to do what? To avoid double taxation by allowing taxpayer to reduce some of the taxes they paid the foreign government against their US liability. Now let's take a look at an example to see how you might see this on the exam. On the exam day, you might see something like this, a simulation or a multiple choice that cover topics like this one. So we have global enterprises, a US corporation which has the following types of income in a given year. So they're giving you various type of income. They want you to determine the foreign source income and the US source income under the circumstances. Starting with $150,000 from its operation within the US. Hold on a second. Where is this coming from? Operation within the US. What's going to happen? This is US income. So as income is generated from business activities within the US, this is business income. Then they got $50,000 from consulting services provided in France. Well, if they provide this service in the US, that will be a US source income. Otherwise, if they provided this consulting services in France, it's subject to the French, it's a foreign source income. So $50,000 is income earned from services performed outside the US. $40,000 of interest income from bonds issued by the Brazilian government. So they bought some bonds and the bond paid interest, and that interest is coming from the Brazilian government. Is this a US source income? No, this is a foreign source income. Interest income from the Brazilian bond is from the payer. Who the payer? The payer is foreign. It's not the US. It's not a US government entity. It's not a US bank. $35,000 of rental income from property located in Spain. Spain, not in the US. Rental property is based on location. This is a foreign income. $10,000 of dividend income from Tech Innovation, another US company. Well, $10,000, it's dividend, a US corporation, a US source income. At the end, you might have to summarize all your income from the US, all the income from the foreign sources, and if you have any deduction, you will compute the deduction as well. Let's take a look at this multiple choice questions from farhatlectures.com. How is rental income from real property located in Germany treated for a US corporation? Is it US sourced income due to corporate residency? Is it German sourced income based on property location? Is it exempt from US and German taxation? That will be nice. I'm going to take C out. That's too nice. Taxed as a US business income regardless of location? No. When it comes to real property, location matter. So it's not regardless of the location, we have to take this one out. So income from real property is based on the location. Where is it located? In Germany. So it's a German sourced income based on the property location. It's not US sourced income because the US corporation owns it. It's where it's located. It's located in Germany. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, additional resources that's going to help you. Whether you are preparing for your CPA exam, accounting courses, some sort of a professional certification. Invest in yourself. Good luck, study hard, and of course, stay safe.